Hello and welcome everyone. This is the fifth part of our lecture series of financial machine learning lecture series, which is called Portfolio Optimization. So today we'll be speaking on such topics as mean variance optimization, how to denoise, detone, and shrink your covariance matrix, what kind of dependence matrix are available in financial machine learning and portfolio optimization. We'll be also speaking on theory-implied correlation matrices. We'll discuss several machine learning algorithms in portfolio optimizations, such as nested clustered optimization, NCO, with optimal number of clusters algorithm. We will also discuss HRP, and in the final part of our lecture series, we will discuss hierarchical equal risk contribution algorithm, which improves the hierarchical risk parity. So let's start with mean variance optimization algorithm. But before that, let's briefly introduce several notations which are used in our lecture series. So we'll denote N big as a number of assets in our portfolio, meaning that we have a investable universe and the number of assets in this investable universe is N. Let's also denote as W the N by 1 vector of asset weights, and Wi corresponds to asset I weight, So basically, if we have three assets and for asset A, the weight is 0.2, in this case, WA is equal to 0.2, meaning that we allocate 20% of our capital to asset A. We will also denote mu as an N by 1 vector of asset expected returns. Here is a small note that in portfolio optimization, defining the expected return of security is not a trivial task. And there are so many ways which you can do that. You can either use the rolling mean of your expected returns, of your previous returns. You can also use analyst predictions, etc. So this is not a trivial task, and we will not actually cover that in our lecture series, but let's just remember that mu is a vector of asset expected returns. Here, by the next notation, the sigma big, we notate that it is N by N covariance matrix, which is estimated from asset percent changes over some period of time. And the diagonal matrix elements correspond to asset variances. So covariance matrix is quite widely used in statistics and probability theory. And of course, this is the key part of portfolio optimization. So let's stop here and briefly discuss how to estimate the covariance matrix. So as we have noted before, we use percent changes of assets price to calculate the covariance matrix. So why we use that? Because, for example, let's take a look at the example of Amazon and some penny stock. So Amazon is quoted, its price quoted in thousands. So, for example, the Amazon price recently was 2,500 or even bigger. And if the Amazon increases by $50 in relative value, its increase is relatively small because the scale of Amazon price is relatively big. But if we take, for example, a penny stock, which costs, for example, $1 per share, and an increase in $50 is a 50 times increase in asset price, which is huge, and it has a huge impact on your capital. That is why, in order to calculate asset variances and to compare them by using the correlation matrices, we need to pass the percent changes instead of the differences or dollar changes. So here, the covariance matrix is estimated from percent changes over some period of time. So what does it mean? Is that we take the percent changes of all assets in our investable universe, and we take, for example, latest 20 days, or I don't know, 60 days. This is also a metric which should be optimized usually by portfolio optimization, because choosing the right time frame to estimate the covariances is not a trivial question. Because if you take a too short period of time to estimate the covariance of your percent changes, your covariances may be too noisy and capture too short-term dynamics. But if you, for example, use latest 5 years, some of these dependencies are do not longer exist because you just use a too big time frame to estimate the covariance. So usually you should start from a medium number of data points, something like 20 days or 62 days or latest quarter to estimate the covariance matrix of percent changes. By A, we denote a correlation matrix. So if you have a covariance matrix, you can actually convert it into n by n correlation matrix. And the diagonal elements in this case for a correlation matrix will be equal to 1 because asset perfectly correlates with himself, with itself, right? So the correlation between Google and Google equals to 1. By RF, we will denote a risk-free rate. So it is a rule of thumb in portfolio optimization is to use US short-term notes as a risk-free rate. But actually, in some of the papers, you can see that the risk-free rate is equal to 0 because that's actually where the short-term notes on US treasuries are. So the expected return which you can get from short-term US treasuries is very close to 0. So that's why some of the asset managers make the assumption that the risk-free rate is equal to 0. By MUT, we denote the investor's target return. So in mean-variance optimization problem, we can set up target return of investor as a subject to optimize, and we will discuss that further. And the final notation is sigma. So sigma is an n by 1 vector of asset volatilities, which is a square root of variance. So let's discuss briefly what kind of statistical moments do we have in finance. So as we have discussed, we have variance. When we create a covariance matrix, the diagonal elements of this matrix are variances. When we take the square root of variance, we get the standard deviation. So why in finance, people came up with a third way of statistical moment, which is called volatility. Actually, volatility is not that different to standard deviation. So in mathematical sense, volatility and standard deviation are the same. But why volatility is called so? Because usually in finance, people really like to measure everything in terms of year return, because when you want to estimate your the efficiency of your investment, for example, in retail or your bank account deposit, you actually get the information on average yearly return. So on average per year, you may get 1% on bank deposit, or when you bought a house and you just rent it, you get an average like 5% on your investment. So in finance, people really connected a link to yearly returns. And when we find the standard deviation of our daily returns, we get daily values. So when you say, for example, your average daily return on security is 0.001, it doesn't mean nothing to you. But when someone said that on average you can get 10 to 15% per year on investing in security, that makes much more sense to you. So volatility is just the annualized measure of standard deviation. So how do we do that? There is a quite interesting rule of thumb how to annualize the daily values of volatilities into the yearly values. There are so many assumptions which are included into this rule of thumb, but it is also quite widely used. So if you want to annualize the standard deviation, if we say, for example, we find the standard deviation of daily returns over some period, you just need to multiply it by the square root of 252 or by the square root of 365. So why do you have these two figures, 252 and 365? So in the second case, it is quite intuitive because on average per year we have 365 days, and if we want to annualize the standard deviation to get annualized volatility, we just multiply that by the square root of 365. So, but why usually in many financial papers you can see that people annualize the volatilities by multiplying by 252, because despite the fact that we have 365 days in a trading year, we only have 252 on average number of trading days. So we have weekends, we have several holidays, and that's why, as a result, we end up only with 252 trading days. So that's why in finance, we usually annualize standard deviation to get annualized volatility estimate by multiplying that by the square root of 252. But still here, despite the fact that volatility is mostly annualized figure, in finance, with time, people just replace the standard deviation term with volatility. So if someone says that the daily volatility of your return is 0.0001, that basically means that it is standard deviation. So here in our further lecture series, we'll just need to mention that volatility in our case just equals standard deviation. So in this case, finance finance notation and notations from statistics and probability theory are on the same page. So let's start with mean variance optimization. So mean variance optimization is also called modern portfolio theory or Markowitz portfolio theory, and it was actually introduced by Harry Markowitz. And this is the algorithm for which he received Nobel Prize I think in economics. So actually, but modern portfolio theory is nothing more than a simple optimization problem bounded by constraints. So what mean variance and modern portfolio theory does is they try to minimize the volatility of our portfolio subject to several constraints. So what are the constraints which may be present in our optimization problem? So the first constraint, for example, here may be that the sum of our weights equal to 1, because usually the most of investors, especially retail investors, do not apply leverage. So, for example, you have 100,000 US dollars and you would like to allocate them into the stock market, right? So as a result, you need to allocate exactly the same sum which you possess right now into the market. So in this case, we say that the sum of our asset weights equals to 1 because we do not apply leverage. If the sum of our asset weights equals to 2, it means that we will use 2 times leverage out of our invested capital. So this is the first constraint, which is extremely understandable, and it is usually the case in finance. What can be the second type of constraints? Actually, for example, most of the investors think in terms of risk and return. And sometimes the investor can either constrain risk, so saying that I don't want the volatility of my portfolio to be bigger than some value, or sometimes the investor would like to optimize its return. So saying that I expect to have at least 20% of return per year. So could you please create such a portfolio which generates this type of target return? So that can be also a constraint, meaning that the target expected return of our portfolio is 20%. So how do we estimate the expected target return? As we have previously discussed, there are so many ways to do that. But how it is estimated? So let's say, for example, we have a vector of expected returns. So for example, our investment analysts analyzed the fundamentals of the company and created a vector of expected target returns for the year for our investment universe. So for example, for Apple stock, we expect a 20% of increase. For some other stock, we expect minus 5%, etc. So how do we measure the expected return of our portfolio? So when you multiply the weight of your asset in your portfolio by the expected return, so let's say, for example, we expect a 20% of increase in Apple stock, and we allocate 5% of capital into Apple stock. So we multiply 5% by 20% and perform this operation for each asset in our portfolio. And when we sum up all these multiplication terms, we get the expected return of our portfolio. Meaning that if, for example, we have 3 assets and all 3 of them have the expected return of 20%, and we allocate 1/3 of our capital to each asset, in this case, the expected return of our portfolio will be equal to 20%, because each asset has the expected return of 20%. We multiply 20% by 1/3 and do that for all 3 assets. So when we sum them up, the expected return of the portfolio is 20%. So let's say once more. In modern portfolio theory, we try to optimize some metric, for example, to minimize the volatility of a portfolio or to maximize the return, bounded by several constraints. So the first constraint can be that the sum of our weights equals to 1. Second type of constraint can be that the expected target return of our portfolio be equal to some value, which is defined by the investor. Or, for example, we can set a constraint on the expected volatility of our portfolio. And this is very interesting because when we have discussed how to estimate the expected return of the whole portfolio, which is multiply individual expected returns of assets in our portfolio by the corresponding weights. But if we want to understand the expected volatility of our portfolio, we cannot perform the same operation. So if you multiply the volatilities, the individual volatilities of your assets by the weights of your assets, you won't get the expected volatility. And this is extremely important. So here, if we take a look at this picture, we try to minimize the volatility. And why we don't just multiply the vector of volatilities by the weight? Because if you want to estimate the volatility of a portfolio, you need to do that in a different way. And that's where covariance matrix comes in action. So actually, how mean-variance optimization algorithm started and what are the beginnings of this approach? Many investment professionals who created various portfolios before modern portfolio theory was invented saw a very interesting pattern. So if you have, for example, 2 assets which show a negative correlation, meaning that when one asset rises and the second asset relatively falls in its price, and if this correlation is quite negative, you can create quite diversified and protected portfolio from different market regimes. So let's take, for example, let's take a small example. You have 2 companies. So the one which creates umbrellas and the second one which creates ice cream. And let's say that in sunny days, there is a huge demand for ice cream, and the company which manufactures ice cream generates lots of profits. But on the other hand, the company which manufactures umbrellas starts losing money because there is no incentive for people to buy umbrellas because it is too sunny. But when rainy weather comes in action, the situation just flips on the other side. The company which manufactures umbrellas starts to generate profits, and company which creates ice cream starts losing its revenue. So what can you do as an investment professional? You can balance your portfolio based on whether it is rainy or sunny day, and to generate consistent profit in both rainy and sunny days. Meaning that in this case, we say that the correlation between these two companies is negative. So, and that's what at the beginning of a diversification is. So if you find companies which are negatively correlated, by rebalancing your allocations between those companies based on market conditions, you can generate consistent profits in all market regimes. So that's where the modern portfolios series started to grow. And if we go back into the volatility to the volatility of our portfolio estimation, we need to take into account not also the individual volatilities of our companies, but also how they interact between each other. Meaning that on the example of umbrella and ice cream company, we need to take not only the individual characteristics of those companies, but also how they interact between each other, because this interaction can massively decrease the volatility of our final portfolio. So that's why when you measure the standard deviation or volatility of your portfolio, you need to multiply the when you measure the variance of your portfolio, if you want to measure the standard deviation of your portfolio, you just need to take a square root of that variance. So if you want to measure a variance of your portfolio, you need to multiply the transpose weight of your assets by the covariance matrix and multiply it once more by the weight of your assets. So this is our target function in portfolio optimization when we want to minimize the variance of our portfolio, subject to a fact that the sum of our weights equals to 1, and the expected target return of portfolio is mu t. So that's actually one case of forming a optimization task in mean variance optimization. So that's why modern portfolio theory is nothing more than just a simple quadratic optimization problem bounded by some constraints. It may seem quite obvious and relatively easy for us, and this concept seems quite obvious. But in recent times, when the portfolio theory and mean variance optimization was initially discovered by Harry Markowitz, it was a breakthrough, because on the first thing why Harry Markowitz received the Nobel Prize for this invention, because he introduced the concept of calculating the risk of your portfolio by introducing this dependence matrix. So he was one of the first who introduced the concept of covariance. So this is a example which is relatively simple on ice cream and umbrella company, but it is quite a good example to show that you need to take into account how your assets interact between each other to measure the risk of your portfolio, because you can actually offset that risk to optimize the volatility of your portfolio and the risk profile. Secondly, Harry Markowitz introduced a concept of risk and return, showing that if you want to get more risk, if you want to get higher returns, you need to also accept higher risks. And he showed a mathematical framework which proves that. And from my side, I would say that one of the biggest breakthroughs was to introduce a covariance and correlations as a way to measure the interdependency and to link the risk of your portfolio with how your assets interact between each other. So using these interactions, you can measure the risk of your portfolio. Because if there is a very strong correlation between your two of your assets, so if you have, for example, two ice cream companies, during rainy days, your investment portfolio will generate extremely big losses because both your ice cream companies will start losing money. So this concept of diversification, of estimating the risk of your portfolio, meaning that the risk of our portfolio equals to the standard deviation of our to the variance of our portfolio. That was one of the biggest breakthroughs of modern portfolio theory. So now let's take a look once more at the optimization task. So here we minimize the variance of our portfolio by calculating the transposed weights multiplied by covariance matrix multiplied by weights, subject to the fact that the sum of these weights equals to 1 and the expected portfolio return equals to ut. So here, this optimization task is just put into, for example, Python optimizer, and it finds that weights which minimize the volatility and still yield a expected target return of ut, and the sum of these weights equals to 1. Actually, we can modify this setting by so many ways. So here in mean-variance optimization, you can go quite far away from a standard setting. So there are several metrics which can be used as target function. So we can use minimum volatility. So we can try to minimize the square root of variance. Usually it will yield pretty much the same solutions, but you can try to use minimum volatility instead of minimum variance. You can use inverse variance setting. You can use maximum Sharpe ratio. You can use efficient risk, efficient return, maximum return minus minimum volatility, maximum diversification, and maximum decorrelation. So you can even use your custom metric. So probably your investor has his own fitness function, which basically he would like to optimize for, and you can create a custom portfolio which may fit best to your investors' constraints. So let's briefly discuss those matrix and how they can modify mean variance optimization setting. So here, let's start with a quite simple, but usually extremely powerful technique, which is called inverse variance. So for this solution, there is no optimization task. So we just need to use the diagonal elements of covariance matrix. And the assets are weighted based on the inverse proportion of their variance. So what we do, we calculate the variances of our assets, which are on the diagonal elements of our covariance matrix. We find the inverse variances of the inverse values of these variances, meaning that if the variance is 20%, we divide 1 by 20%. And after that, what we do, we find the sum of the these values of these inverse variances, and the asset weight is just the inverse variance of this asset divided by the sum of inverse variances in our portfolio. So why this technique is so powerful? Because it is relatively simple, but it is quite, there are many logical explanations for that. So what you do is you give higher allocations to those assets which show less risk. So you allocate less risk to less risky assets, and you allocate higher weights to less risky assets and lower weights to risky assets. And actually, inverse variance sometimes shows very good results, even better than those weights which are found by quadratic optimization problem. So inverse variance later will be used in HRP and Herc algorithm, and it is quite powerful technique which you can use. And one of the advantages of this technique that you don't need to perform difficult optimization tasks to find the inverse variance portfolio. You just need to divide the inverse variances of assets by the sum of inverse variances, and that's it. What you can also do is to maximize your Sharpe ratio. So as we have discussed, we have on the one hand have the return which we would like to get, but on the other hand we would also like to minimize our risk. So this is always a balance between return and risk, and how we can balance between these two things. What you can actually do is you can estimate the efficiency of your strategy by dividing the return of your portfolio by the risk of your portfolio. So let's say, for example, you have two strategies. So the one which yields 100% per year, which are huge numbers, with 50% of risk, and the other one which, let's say, for example, 20% of return with just 1% of risk. So on the one hand, if you are a risk seeker, you would go for a strategy which generates a 100% of return, right? Because it generates huge profits. But on the other hand, your risks are also huge. So you need to be prepared both financially and mentally to survive some serious drawdowns in your strategy. On the other hand, you have a strategy which generates 20%, which is 5 times less comparing to the strategy which generates 100%, but the risk of this strategy is just 1%. Any investment professional will tell you that the second strategy is by far much more investable and attractable to them, because if they divide the return of the strategy for the first strategy of 100 and divided by 50 the risk, they get a information ratio, or aka Sharpe ratio, of 2. But if you perform the same operation for the second strategy, so you divide 20 by 1, the Sharpe ratio or information ratio of this strategy equals to 20. So the risk adjusted, it is also called a risk adjusted performance. The risk adjusted performance on the second strategy is much higher compared to the first strategy. And the most of the investors will be much more willing to invest into the second strategy rather than the first one. So why do we operate with some matrix as Sharpe ratio and information ratio? So in recent years, the Sharpe ratio and information ratio mean pretty much the same thing. So originally, the Sharpe ratio of our portfolio is the expected return of our portfolio, so the return of our portfolio minus risk-free rate divided by the square root of the variance of our portfolio. So we basically divide the return of our portfolio by the standard deviation of our portfolio, right? So this is the Sharpe ratio. So here we use the risk-free rate because usually when the Sharpe ratio was initially invented, we wanted to compare how well do we perform comparing to a risk-free asset. But right now, risk-free asset, which is short-term notes of US Treasuries, yield almost 0%. So that's why this term of risk-free rate became 0. And in this case, Sharpe ratio becomes information ratio, because in information ratio, we just divide the return by the standard deviation of our portfolio. So that's why sometimes many investment professionals in these days say that the Sharpe ratio equals to information ratio, just because the risk-free yield equals to 0. But if we go back into 80s, 50s, and 70s, the risk-free return was far away from 0, and that's what should be taken into the account. So in maximizing the Sharpe ratio problem, we'd like to maximize, as we have discussed, the expected return minus risk-free rate divided by the standard deviation of our portfolio. So here you can see that this formula calculates variance. So this is variance, and we take the square root of that, it becomes standard deviation. subject to a fact that the sum of our weights equal to 1. We can also put a subject that a constraint that the sum of our weights is more than 0, because we don't want to hold short positions in assets. So if we have a negative weight of our asset, it means that we take a short position in that. And there is a major problem with this kind of optimization technique, and a major problem with the above formulation is that the objective function is not convex. And usually dealing with non-convex optimization problems is quite difficult for us. And as a result, this problem can be transformed into an equivalent one, but with a convex quadratic objective function. So that's how it can be actually transformed into a convex problem. So why convexity of optimization problem is quite important for us, because if we deal with numerical methods of optimization, and that's actually like 99% of our time we deal with a numerical way to solve the optimization problem rather than analytical. It is important to have a convex problem, because if the problem is non-convex, there is a pretty high probability that found solution, either maximum of function or minimum of function, won't be the global value. So our optimization algorithm will stop at some point saying that it is a minimum value, but actually the minimum value can be far away from that. And that's actually what you may face in uh, non-convex optimization problems. But if your problem is convex, there is a very low probability that your optimization algorithm won't find the true minimum. So the true minimum is also called a global minimum, and the minimum which is somewhere around the true one, but is not the true one, is also referred as local minimum. So these two problems are actually the same, but we specifically modify the initial optimization setting so that our algorithms are easier to find the global maximum or global minimum of our problem. So now let's go into the efficient risk setting. So for this solution, the objective is to minimize risk given a target return value by the investor. So know that the risk value for such portfolio will not be the minimum, which is achieved by the minimum variance solution. However, the optimizer will find the set of weights which efficiently allocate risk constrained by the provided target return. Hence, the name is efficient risk. So if we go back to the first slide, that is actually the setting for efficient risk, because here we have the target return of which is set by our investor. So if you want to just minimize the variance of your portfolio, you just need to take away the final term, and the problem will be minimizing the variance of our portfolio subject to a fact that the sum of our weights equal to 1. But if we want to find the minimum variance portfolio subject to a fact that the target return of our portfolio should be equal to UT, this optimization problem is called efficient risk. So we want to find the most efficient way to allocate risk in our portfolio subject to a fact that we expect a target return being equal to, for example, 20% or 30%. It doesn't matter. So that's why this problem is called efficient risk. Another problem, so it is the inverted way to approach the problem, is so-called efficient return. So for this solution, the objective is to maximize the portfolio return given a target risk value by the investor. So this is very efficient risk solution. So the optimizer will find the set of weights which efficiently try to maximize return constrained by provided target risk. Hence the name is efficient return. So here we want to maximize the return of our portfolio given a fact that we have a preset level of risk. So where this kind of problems arise. So for example, we don't want to exceed the risk value of 10%. So have, for example, quite conservative investor who comes to your hedge fund and says, okay, so I have this level of risk. How for this level of risk you can maximize my return? So that's actually the type of efficient return strategy. So, and you create a portfolio by using this optimization problem to maximize his return, but the target risk remains the expected value which was set by the investor. The next step is so-called maximum return minus minimum volatility. So this is also referred to as quadratic risk utility type of problem. So the objective function consists of both the portfolio return and the risk. Thus, minimizing the objective relates to minimizing the risk and correspondingly maximizing the return. So here, lambda, so we can see in this optimization setting a new parameter, which is called lambda, is a risk aversion parameter, which models the amount of risk the user is willing to take. A higher value means the investor will have high defense against risk at the expense of lower returns, and keeping a lower value will place higher emphasis on maximizing returns, neglecting the risk associated with it. So this max return minus minimum volatility is the way to generalize previous optimizations problems as efficient risk and efficient return. So let's say, for example, the investor comes to your hedge fund and says, okay, I don't know the target risk of my portfolio, and I don't know what to expect in target return. Let's speak about that. So we can actually do is to talk to your client, give him several psychological tests, and to understand what is his risk aversion, what is his risk aversion appetite. So probably he's a super risk seeker and he would like to maximize his return as possible. Or maybe has very low appetite for risk and he would like, and he's very conservative um, in his investments, and he would like to have a quite low level of risk, but still wants to optimize his return. But sometimes he can be somewhere between these two categories. And that's here you need to you can introduce the lambda, so to estimate the lambda value based on conversation with him, and to estimate the risk aversion parameter for him, and say, okay, so your risk aversion parameter is this, and that's why we'll optimize the portfolio for you, and uh, we will optimize a portfolio for you based on your risk aversion parameter. So on the one hand, we'll minimize the volatility as you need it, defined by your risk aversion parameter, but still we'll try to maximize your return. But take a look at very interesting thing here. As you can see here, we want to maximize the return minus minimum volatility, but here we have the minimization type of problem. That's actually the trick which many data scientists do. So the most of the algorithms which are implemented in optimization libraries are aimed to minimize the value of function. But if you want to maximize the value of function, what you can do is to multiply the function value by minus one and to minimize that. And in this case, if you multiply the function value by minus one and you minimize the value, in this case, you will maximize the value of the original function. So here, as you can see, we have multiplied the expected return minus minimum volatility taken into account risk aversion, and we instead of original minus in this formula, we get plus sign for this part of the equation and minus for the expected return. But here, in this case, we'll minimize the value of our function. So as a result, the minimum solution here will correspond to a maximum value of max return minus minimum volatility. So this mixed minimum maximum trick is quite widely used and can be applied even in your custom optimization type of problems. So now let's go further and to talk about diversification. So maximum diversification portfolio tries to diversify the holdings across as many assets as possible. So in the 2008 paper, which is called Toward Maximum Diversification, the author of the paper introduced the so-called diversification portfolio, the diversification ratio of a portfolio, which is defined in the next formula. So we multiply the transposed weights to the volatility of to the volatilities, and we divide it by the whole volatility of the portfolio. So here we and that's actually what we were referring to, is that when you try to estimate the volatility of the variance of your portfolio, you need to you need to multiply the weight by the covariance matrix by the weight, the vector's weight. And if you want to find the standard deviation, you need to find the square root of that. And it does not equal to multiplying weights by either volatilities or variances. So this is the diversification ratio, which was introduced in the paper, and we want to maximize that. So still, you can actually minimize the minus d value. So you can put minus in front of that, and to minimize that, if you use standard optimization Python libraries. So max diversification is another way to tackle the problem of portfolio optimization, because usually your minimum risk lies in a portfolio which has a very high diversification ratio, meaning that the capital is relatively spread between your assets. You have high diversification, and you just minimize this value when you build a portfolio. The final way of finding the mean variance solution is so-called a max decorrelation. So it is a minimum variance optimization that is performed on the correlation matrix rather than the covariance matrix. So instead of just using the covariance matrix, we use correlation matrix instead of that. So we multiply our transposed weights by the correlation matrix and still multiply it by the weights vector, and would like to minimize that. So this is called a max decorrelation type of problem. Now, let's also take a look at one of the crucial algorithms in modern portfolio optimization, which is called the critical line algorithm, or CLA. So critical line algorithm is a robust alternative to quadratic optimization used to find mean variance optimal portfolios. So the major difference between classic mean variance optimization and CLA are the optimization constraints involved. So it is the only algorithm specifically designed for inequality constrained portfolio optimization problems, which guarantees that the exact solution is found after a given number of iterations and yields the entire efficient frontier. So let's split this big sentence into several parts. So actually CLA is almost the same thing as mean variance optimization, but what it does, it makes sure that, it makes sure and guarantees that the exact minimum value is found after a given number of iterations. So previously we have discussed that in some type of optimization problems in modern portfolio theory, in mean variance optimization, the minimum solution cannot be found sometimes because the problem is non-convex. And the CLA algorithm makes sure that for your inequality type of problems, so for this type of problems, so we minimize the variance of our portfolio subject to the sum of weights equals to 1. And in critical line algorithm, we have the next way of constraints, which are the upper and lower bounds for our portfolio, for our assets values. So for example, sometimes you would like to say that I don't want to have more than 20% of my portfolio in, for example, in Apple stock, or I would like to have at least 5% in Tesla stock. So these are our upper constraints and lower constraints. So we still want the sum of our weights to be equal to 1, and at the same time, we'd like to minimize the volatility. And if you want to make sure that the exact right solution which addresses all these problems is found, you should use critical line algorithm. But on the other hand, you can try to use mean variance optimization setting with these constraints, and probably in the most cases, you will find the exact solution which was found by the CLA. But the advantage of critical line algorithm is that it guarantees that the exact solution is found. But at the end, CLA is pretty much the same as mean variance. And the second thing which CLA algorithm does, it builds so-called the efficient frontier, which is also called Markowitz bullet. So let's take a look at that. So if you Google mean variance optimization or modern portfolio theory, this kind of image that you can see usually will arise in pictures which describe this block of portfolio optimization. So this is called the efficient frontier plot. So what it does, so for example, you can generate, you have the portfolio which contains of 3 assets, right? And what you can do, you can allocate various ways to your portfolio and to understand what are the expected return of your portfolio and what are the expected risk of your portfolio, right? And you can generate various combinations of that and put them into the plot. So here we plot for each that portfolio the return and the volatility of the expected volatility of our portfolio. So here we can plot various different portfolios, and we plot the return and the volatility. And here we plot here the line which is called the efficient frontier. So why it is called that? Because let's take, for example, the portfolios which lie on the efficient frontier. So let's take, for example, this this portfolio, so this dot. So here it has the expected return of something like 22% with a volatility of 23. But we also can get a portfolio with a volatility of 23, but with a lower return. So what this critical line shows us is that all portfolios on this efficient frontier are the most efficient way to allocate your risk and return. So there is no incentive for us to go into the portfolios which are inside of this critical line, because for each portfolio from this area, we have a corresponding portfolio with the same either return or volatility. So for each portfolio in this area, so the area which is inside of the efficient frontier, we have a portfolio with the same return but with lower risk. And on the other hand, for each portfolio inside of this frontier, we have the portfolio with the exact return but with lower risk. So for example, we cannot say if this portfolio on efficient frontier is better than this one, because on the one hand it has lower volatility but also lower risk. This one has higher volatility and also higher risk. So we cannot say which one is better, but we can definitely say that the portfolios which are present on efficient frontier, for example, here with a volatility of 16 and the expected return of 10, all these portfolios which are inside of critical line are worse, because for this type of expected return of 10%, for each of these portfolios, you get a higher volatility. So you take more risk for the same amount of return. So there is no incentive for you. And that's actually what critical line algorithm does for you. It builds the whole efficient frontier here. And as a result, you can take a look at the shape of this efficient frontier and understand what kind of portfolio you can actually choose based on your preferences on either return or risk. And this is one of the very important things which Harry Markowitz did by showing this plot, is that actually showing that um, that you can, so all these portfolios on this efficient frontiers are the most optimal way to allocate your capital. So any portfolios which deviate from this efficient frontier are non-optimal, because for the same risk you can get either lower return, or for the same return you can get higher risk. So what he did, he connected the risk and return, saying that you can actually, for higher risk, so here for higher risk you need to accept higher volatility. For lower volatility you need to accept lower returns. But there are also non-optimal solutions where you can find a better portfolio which will either minimize the volatility or maximize the risks. So he showed that there are several portfolios which are absolutely non-optimal because they don't yield the perfect combination of risk and return. So this is the portfolio optimization this is a modern portfolio optimization block. And in the next lecture series, we will discuss what are the disadvantages of this approach and how do we use portfolio lab functions to generate portfolios from modern portfolio theory algorithms.